Let me tell you a little bit about Andrews and how our company performed. In the 8th round, we held first place in 4 different categories: sales, cumulative profit, return on sales, and market capitalization. Our sales topped $184 million, far ahead of our next competitor. Our cumulative profit was $135 million, more than double the number 2 spot. We also achieved 19.5% for return on sales, again far ahead of the next company, in line at 11.6%. Market capitalization was an impressive $338 million, with our nearest competitor less than half. What's the secret to our success? How did a group of amateur entrepreneurs not just succeed, but exceed the competition in all of these areas? At the core of our strategy was risk. We took calculated risks to push the envelope and achieve impressive results.
In the beginning, we knew that our change in stock price and net income would be on the negative side for each round, but still we continued to spend. We borrowed as much long-term debt as possible and issued maximum stocks, which gave us plenty of extra capital to invest in our capacity and automation. We continued with this method for the first 3 rounds.
Not to borrow as much. Our net income went into the black. However, we still spent as much as we could in order to ensure that our awareness and accessibility were at their highest points. During this time, we were confident that our market share was superior to our competitors. By spending the maximum amount before diminishing returns in TQM, we drove our margins up. We knew that we also needed to spend the maximum amount before diminishing returns in HR to drive our productivity index way up. This maneuver resulted in a key advantage. We ended up paying our employees less for more labor than our competitors. During these rounds, our competitive advantage grew stronger than ever.
Regarding production, we were adamant in setting Able as our low-tech product. We updated it at 2-year intervals while releasing a second product, Adriux, in the high-tech segment. All of these motions allowed us to adopt an aggressive strategy early in the game and maintain a large chunk of the market share. We borrowed enough long-term debt, or alternatively issued enough stock to make sure we would have a closing cash position of at least $5 million. This protected us from possible risks, such as unforeseeable issues and inaccurate forecasting.
For the most part, our strategy worked almost exactly as it was envisioned. By round 5, we were impressively ahead of all our competitors. During the remaining rounds, we made the right decisions and managed to maintain our position.
As risk-ready entrepreneurs know, make or break issues color businesses from beginning to end. Our first issue presented itself in the first half of the rounds. We had to combat the challenge of rapidly increasing the capacity in order to match the market share. We didn't anticipate how much demand there would be for our product, and for those first few rounds, ended up stocking out.
Once the capacity rose and that issue balanced itself out, another problem materialized. We had to deal with forecasting correctly and avoiding carrying too much inventory. Another mid to late round challenge was getting back some of our previously lost high-tech market share. A competing company a step below us had 2 products that totaled to 30% of the market share, while we had just 1 product at 25%.
To solve this issue, we decided to introduce a new and cheaper product of our own that we positioned in the segment center, rather than being the ideal spot where our first high-tech product sits. Due to the new product's material cost being cheaper, we were able to charge much less for it compared to Adriux. This would allow us to capture a large part of the high-tech segment that would rather pay less for a product that is still considered high-tech. This risky yet well-timed move allowed us to once again dominate the total high-tech market share. We also had enough retained earnings at that point to immediately finance the new product's plan up to the correct automation and capacity.
As all intuitive entrepreneurs know, it is always necessary to have turnaround plans. If things were to go south financially for our company, we had a considerable collection of investments that we would have liquidated to pay off any debt we might have had to borrow. The plan, if ever applied, would have helped us avoid emergency loans. We never showed signs of being in a real crisis or even approaching a crisis, so this was the only turnaround plan we needed to discuss.
Our strategy was to borrow long-term debt so that we would have the capital necessary to invest in the company's capacity and automation during the initial rounds. What that means is that you won't have to pay the principal within the time limits in the simulation. However, the incoming management will need to be prepared to pay off the long-term debt borrowed. An option to consider is to begin saving retained earnings and to sell any excess capacity while keeping second shift production between 20% to 50%. With the retained earnings, you can pay off these debts early. The loans will take a toll, but they will remain manageable thanks to the profitability of the company.
When the time comes, you should retire the first high-tech product while concurrently releasing the next high-tech product. This is because the perceived age of a product will increase regardless of the revisions made to that product. As a result, our company would be put at a disadvantage if we decided not to replace our first high-tech product. The optimal time to perform the switch would be within the next few rounds.
To drive up our margins even more, feel free to experiment with automation levels for our high-tech products. The levels are currently at 6.5. However, they might be able to be pushed to 7.5 or higher. The key is to make sure that when you revise the size and performance each year, the revised product doesn't have a release date later than early June. If the release date is later than that, you know it's time to scale the rating back.
Our final piece of advice is this. Once the principal of the long-term debt has been paid off, you will be required to start spending money again. One option you have is to allow Able to age and allow Adriax to drift to the center of the low-tech segment to take Able's place. Able will become an extremely low-tech product equipped with high automation and low material cost. As a result, you will be able to price Able quite cheaply. Meanwhile, Adriax will take over Able's position as a low-tech product, and Ace will retain its position. During this time, it would be ideal to release another high-tech product in the ideal spot of the high-tech segment, and minimize the perceived age of the product as much as possible.
After 8 rounds of competition operating as Andrews Inc., our key takeaways were, firstly, be aware of your competition. Be aware of its product offering, price points, and planned improvements for the products. Be ready to react and to outperform. Secondly, communication is key. Involve all departments in the overall strategy. Hold regular update meetings to ensure all decisions are well informed. And lastly, stick to your long-term strategy. Take the necessary steps to stay on track.